What is the one metric that can tell you most of what you need to know about any business? Specifically, maybe you want to make a long-term investment in a business. What's the one measurement to look at? Or maybe you want to acquire equity in a business and help them to scale. Or maybe you just want to help the business improve, either your own or one that you are consulting or coaching at the moment. If you could only track one metric, what would it be? Hi, my name is Dr. Alan Barnard. I'm CEO of Golden Research Labs, and we focus on studying why good people make and often repeat bad decisions with the goal of using that research to help them make better, faster decisions when it really, really matters. A key part of this research is to look at metrics. Why? Because metrics typically tell you when a change is needed, tells you what changes are needed, and how to make these changes that will actually result in the desired benefit. I've been contemplating this question for a long time, starting 30 years back when I was actually part of the executive teams of corporate, to more recently where I'm working as a strategic advisor, coach, and consultant, and helping businesses from all sizes and all different types of industries just improve. I have concluded that the ideal metric or set of metrics should satisfy three criteria. So what are these criteria? Firstly, the metric should help you to accurately measure the status of the system. And by accurate, I mean just outside of the noise, a very quick way of judging, good enough way of judging, is this business doing great, good, okay, bad, or terrible? Very quick way of judging what the status is. The second one is it must accurately predict, again to the level of good enough, the major causes of that status. Why are we doing great, good, okay, bad, or terrible? And specifically identify those causes that are in our control versus those that are out of our control. That will be very useful when we are having to decide what interventions or improvements or changes are needed. And then the last criteria is that if this metric is used as an incentive for the leadership at every level, will it get them to do what's best for the system or the business and not just for their part? So those are my three criteria. I want to share with you a couple of examples. And as I'm stepping through the examples, I will check it against these criteria. So the overall criteria is status. Does it accurately tell me the status and the gap in that status between the actual and desired or possible levels? Secondly, the causes. Does it accurately help me to quantify the made causes? And thirdly, does it create the right incentive? When I started looking at investing, I knew nothing about it. I'm an engineer and a scientist, knew nothing about investing in companies. So I asked around those people that knew a lot about it, and I said, just go and study what Warren Buffett and Charlie Munger is doing. And it was very interesting when they were asked what's the one measurement that they look at when they start looking at a business. They said it's return on invested capital, ROIC. For those that don't know, return on invested capital is essentially measured as your profit after tax divided by your total invested capital. So total capital coming from both debt and equity. When they compare it with cost of capital, it's a quick way of judging how good this company has been, how good their management team have been in terms of making changes that improves that return on invested capital. So if the current cost of capital is 8%, you want a return of invested capital to be above that, and ideally way above it. So I'll give you some examples from automotive and from retail. If you take a company like Ford or a retailer like Gap, they're running at about 2% return on invested capital, way below the 8%. That's not good. If you take a company like Toyota and H&M as a retailer, they're running at about 11 to 12% ROIC, which is pretty good. It's above the 8%. But if you take a company like Tesla and Zara, these companies are running at 17 and 22% return on invested capital. That's really good. Does it tell you also what the major causes are of that status? So if it's bad or good? Yes, because it's a ratio. And I suspect that all metrics have to be ratios because it must embed the trade-off in. If you think about if you were only measuring net profit after tax, it would create an incentive to get net profit up at all costs, regardless of how much capital it requires. If you were only measuring capital, they would try to minimize capital. Like if you had a cash constraint, try to minimize capital, and that could cause you to not have enough inventory, to not offer good trading terms, and that could affect the net profit again. So you need to have a ratio And that ratio, if you study the ratios, where's the problem? Is it in the top line or the bottom line? If it's in the top line, which parts of the top line is it? So it gives you a strong hint about the cause of the status and which ones of those are in your control in the short term, medium term, long term. And last criteria, if you were using this as the primary metric for the management team, the leadership team, would it get them to do what's best for the whole? Certainly Warren Buffett believes that. So let's look at a second one. This is one that I learned recently. I was invited to attend a scaling workshop by the inspirational team of Alex and Layla Ormozy. They've got a company, acquisition.com. And in the scaling workshop, a 2-day workshop, they were teaching business owners that attended how they are using theory of constraints to have scaled their own company so fast and at quite low cost and low risk compared to anything else, and also how they do the same for their portfolio of companies. So I was particularly interested to see what's the one measurement that they were using. And it kind of took me by surprise, but in hindsight, I think it makes sense from applying these 3 criteria. They look at lifetime value over customer acquisition cost, LTV over CAC. So think about that. What they are claiming as a threshold is if it's 3 to 5, the company is doing pretty good. So you're putting in $1 to acquire a customer and you're getting $3 to $5 back as lifetime value. That's pretty good. If it's less than the 3 towards the 2 or the 1, that's not good. If it's less than 1, it's really, really bad. But what they've shown is that by using this as one of the primary metrics and incentives for themselves and for their portfolio of customers, they've achieved levels that are incredible, up to 30, up to 100. So imagine that you're putting $1 to acquire a customer, you're getting $30 of lifetime value back, or sometimes $100. That's pretty remarkable. You'll basically just, where can I get more money to put into this money machine? So I think it's a great way of quickly checking the status in terms of figuring out, can they help this company scale much faster with lower cost and risk? I think it provides a useful indication about what the primary causes are that's under their control. Is it an LTV problem? So for example, if their LTV is not much bigger than the first time purchase of the customer, that tells you that they're not doing a good job at managing the success journey for that customer. And that's probably where you want to focus on. It might be that you are not identifying the right dream customers that get ongoing value, or you might not have a good offer, or you're just bad at selling to them. Or it could be a customer acquisition cost problem where you might not be aware that there's much cheaper ways of acquiring customers, maybe even free ways like doing referrals, etc. So that makes perfect sense. And as I mentioned, using this as a prime metric, they believe gives them the right incentives and also the leadership team of the companies that they've acquired equity to. I suspect that the one metric is very much dependent on your goal. For investors like Buffett and Charlie Munger, it's all about, does it tell them if this is a good candidate for making a long-term investment in? For acquisition.com, the Moses, they look at it from a point of view is, does this company want to scale? If they want to scale, how are they doing? Are they doing okay, not okay? And lifetime value over customer acquisition cost is a really useful way of judging that. My goal has always been different to that, whether I was part of the leadership team of companies that I was part of, or being a strategic advisor or coach or consultant in companies. My goal has always been to help them improve. So what is a good metric, I believe, to help you check the status of the company in terms of improvement, the likely causes and improvement potential, and will be a good incentive if it was used? I use a measurement that was originally developed by Dr. Goldert as part of throughput accounting. The way that we, in theory of constraints, measure productivity at the company level is we measure operational and capital productivity. Operational productivity is throughput over operating expenses, and throughput is simply the sales revenue minus total variable cost. So it's the rate at which the system is making money. It's like the gross margin. And below the line is the operating expenses. This is the rate at which you are spending money. So looking at that ratio without knowing anything about this company can tell you a lot about the company. Has their management team been successful at growing the rate of making money faster or slower than the rate at which they are spending or investing money? For capital productivity, it's throughput over I, or investment. So it gives you a quick snapshot of the status. Are they great, good, okay, bad, or terrible at doing that? Does it give you a strong hint about the causes of the status? Again, because it's a ratio, you can look at which one is the most contributing to this. Is it the top line? Their throughput is just much lower. If throughput is much lower, is it a revenue problem? Is it a variable cost problem? Or is it a bottom line problem, OPEX or investment? If it's used as the primary incentive or metric to drive the incentives for leadership team, we've often seen dramatic improvements because it's getting them to do the right thing. So in the early 2000s, I was leading a big implementation of theory of constraints at Cisco Systems, and the team there challenged me to come up with a metric that could be used for any business unit or even business process. And what I did was I took this metric and I transformed it into an operational and capital productivity metric for any process or any department or business unit. I call it TQ over OE or QT over OE, depending on what your preference. So T is for throughput. In this case of a business process, throughput is not a dollar value like in a case for a company, but it's still the rate at which that business process is doing what it's supposed to be doing, generating the work to meet the demand that the system is placing on it. That might be processing all the invoices or doing the lab tests or producing the widgets or processing customers. So it's essentially just calculating the rate at which it's generating those goal units or doing the work. It could be project tasks, etc. Quality is what percentage of that throughput of the work that was completed in the last period actually met the criteria for customers in terms of defect rates, on time in full, etc. And then the operating expenses is all the cost that you've incurred to generate that quality throughput. The same with capital productivity, it would be TQ over investment. So again, comparing the rate at which you are generating goal units over the rate at which you are spending and investing. And if that ratio is more than one or leaning upwards, so the gap is growing over time, you know they're doing a good job when it comes to improvement. If they're growing the cost and the investment at the same rate or maybe even faster, then they're not doing a good job. Does it give me a strong hint about the causes? Yes, because it's a ratio, I can now see where's the problem. If it's a throughput problem, it typically means that they are not meeting the demand. And that would be the first objective, is how to do more faster until they fully meet the demand. That's what the upper limit is for them on throughput. The upper limit on quality is meeting the quality requirements, defects, on time in full 100% of the time. Maybe that's where the biggest problem is. So they're doing 1,000 widgets, but only 80% meets the criteria. So let's get the quality up to 99%. Or they may be doing only 500, the demand is 1,000, the 500 quality is 99%, we just have to help them do more faster. And then below the line is, could it be a cost problem? So firstly, do more faster, then do it better to meet the quality, and then lastly, do it cheaper, less cost, less investment, without it negatively impacting the quality or the throughput. And that's, again, why it's so important that it's a ratio. In summary, I hope that you've gained some value from this that says when you're thinking about a single metric or a very limited set of metrics that you could use to evaluate a business, you should start by saying, what's the criteria that these measurements should satisfy? It should accurately measure the status. Are we okay, not okay? Accurately measure the likely causes of the status, specifically those that are in my control, that I should be acting on to improve that metric. And lastly, if we use the metric as an incentive, would it reward the desired behaviors? Would it penalize the undesired behaviors? Because it's a ratio, if we're too cost-focused, then throughput or quality is going to be compromised, and they will pay the penalty for that. If we're too throughput-focused, then we might pay the penalty with quality or with cost. So it's important that the metric is a ratio. I'm looking forward to getting your feedback on this. Focusing on the right metric, I think, is a key part of making better, faster decisions when it really matters, and is a key part to achieving a process of ongoing improvement in your organization, regardless of the size of the organization, regardless of the industry. I hope that was useful. If it was, please share this, please like it, and I'm looking forward to your comments about what you think the primary metric should be that you pay attention to, and provide us a bit of context as what's the goal that you're trying to achieve Are you a business owner? Are you a manager in an organization? Maybe you're a consultant or coach or advisor. That will help to put us the context. We do have a competition going on with the one that comes up with the best metric. They will qualify for some incredible prizes. I'll put that down in the comments level.